Hello, and welcome to episode 11 of this series on flourishing in an age of narrow abundance. This is the second part of my deep dive into flourishing and AI. And this is the first principle for how we can survive, thrive, and flourish in a world of artificial intelligence. This question is more important than ever, and it seems to be on the tip of almost everyone's tongues. So, this essay, Be a Complement, Not a Substitute, takes me wonderfully back to my A level economics, thinking about all of these concepts and assuming that they are hard facts, assuming that they are science, some form of social science. There were rules that fit. And then obviously, as you explore it more, we go on and talk about the concept of value, the concept of scarcity, productivity, etc. We understand that these are artificial constructs to a greater or to a lesser extent, and therefore change with time and aren't necessarily locked scientific rules. So it's been really interesting to look at some of these principles that I probably haven't looked at for quite a long time. Obviously, we're contextualizing it in an age of AI. Our goal as humans is to become complements to artificial intelligence, certainly not substitutes to artificial intelligence. The last thing we want to do is to compete with AI on things that AI is going to do better, cheaper, faster, etc. We need to find areas where we can carve out a niche, a human niche, and there's a willingness to pay. There's scarcity and a willingness to pay, the base elements of value creation. This essay was fun to write also because I got to pretend, only for a paragraph, that I was a world-class artificial intelligence researcher with lots of companies lining up for my very, very valuable, very, very scarce services. Unfortunately, that doesn't happen. Secondly, I got to play the role, maybe for 2 or 3 paragraphs this time. I got to imagine myself as a magician, which again is never going to happen. I can't do a magic trick to save my life, but hopefully the example of me stepping out as a kind of jobbing local magician gives a little bit of context and a bit of a illustration of some of the concepts that we're talking about here. This essay, again, is part of a set of principles. I think there are probably 4 or 5. There might even be more principles as I continue to explore this space. I really hope that you enjoy this essay and get a lot from it. Again, it's a little bit more economicsy than some of my previous essays, but look, this is the joy of being able to write what I want. I can go from philosophy to neuroscience to AI stuff and into economics. So I hope you enjoy it. Until next week. Flourishing and artificial intelligence. Principle 1, be a complement, not a substitute. In the newly industrializing heartland of early 19th century England, a mythical figure, Captain Ned Ludd, became the totemic figurehead of the disparate Luddite movement. Factory owners who were becoming increasingly wealthy by replacing high-quality, human-made textiles with mass-produced alternatives suddenly had something to fear. Ned Ludd stood for the workers, the skilled craftsmen and artisans, the weavers and the textile workers. Ludd's legend united disparate communities of factory workers from Nottinghamshire to Yorkshire who were intent on literally destroying many of the technological innovations, including the stocking frames and the cropping machines, that had driven so many skilled textile workers into poverty. According to Brian Merchant, the author of Blood in the Machine, The Origins of the Rebellion Against Big Tech, the Luddites were against certain technologies because they recognized the way that they were going to be used in a social and economic context against them as workers. It was a labor movement. It was an anti-poverty movement. It was not an anti-technology or an anti-progress movement. The wide frames, gig mills, and shearing frames that the Luddites destroyed were a substitute for the labor of thousands of skilled textile workers, favored by factory owners due to their increased output and lower costs. In the jargon-filled world of economics, a substitute's uneasy bedfellow is a complement. Complements are things that you can buy when something else is being consumed. For example, ink cartridges and printers, or a can of Fanta with your lunchtime sandwich. Substitutes, on the other hand, are things that you buy instead of consuming something else. My Netflix subscription and my Disney Plus subscription are substitutes for one another. I can easily swap one for the other and still enjoy an unlimited amount of content. Choosing whether I fly, take the ferry, or get the Channel Tunnel from London to Paris is another example of a substitute. Importantly, when the price of a product goes up, the demand for its complement goes down. More expensive printers, less demand for ink. And conversely, the demand for its substitute goes up. Cloud storage, photocopiers, etc. The concept of complements and substitutes can be applied to our work. If we do a job that has plentiful substitutes, either in the form of equally well-qualified labor or from machinery, our bargaining power and our job security tends to decrease. Conversely, if we position ourselves as complements to new technological breakthroughs where the price of the complement keeps going down, we are likely to have greater bargaining power and more job security. For example, software engineers during the proliferation of the internet and smartphones, and financial analysts as the digital infrastructure of modern finance was being commoditized. To flourish in an age of artificial intelligence, we cannot afford to become substitutable by the growing number of jobs that artificial intelligence can and will soon be able to do quicker and cheaper than us. Instead, we must seek to find work where we, as humans, have an enduring advantage. We might end up complementing artificial intelligence by focusing on the things that humans do best within modern business: selling, storytelling, and strategy. Or we might start to revalue a whole class of jobs where artificial intelligence cannot provide a feasible substitute. As writer Packy McCormick asserts, in the future, the losers will be those who behave like machines, the winners will be those who behave most like humans. To better understand how we can position ourselves to flourish in an age of artificial intelligence, we need to explore three important terms: scarcity, productivity, and value. Scarcity. As you read this, there are entire industries of analysts, associates, vice presidents, and managing directors clacking frantically away on their keyboards, busying themselves in meetings and conferences, taking notes, making progress, pushing forward. Worker bees, keeping their heads down in service of the institutions for which their bonus and their promotions depend. These workers can judge their value by their relative position within their firm and their monthly payslips. Surely, they think, they are productive and valuable contributors to society. Just look at how much they're getting paid. These workers are valued based on their scarcity and their productivity. Let's assume that I have spent the last 20 years becoming the most qualified, most productive artificial intelligence researcher, capable of unlocking millions of dollars of revenue for any number of hungry technology companies desperate for a competitive edge. Only a few other researchers, most of whom are indentured by stock options and non-compete clauses, are as experienced or as productive as I am. And therefore my labor is extraordinarily valuable, sold only to the very highest bidder. My value lies in the fact that there are very few realistic substitutes for my extremely productive labor. My price, or my wage, is a representation of my value for the companies that end up competing for my talents. These dynamics continue to hold further down the scarcity pyramid. Jobbing investment bankers get paid a lot because they are moderately scarce resources. University graduates who are willing not to have a life eat most of their meals from their desks, taking orders from bosses, wired on coffee, driven onwards by mortgage repayments and private school fees. They have relatively high levels of productivity in the sense that their labor creates quite a lot of value add, revenue generation over and above their wage, As these investment bankers get more senior, their experience, reputation, and network makes them more scarce, more productive, and therefore more valuable, earning a higher wage. What happens, therefore, when a series of new technologies threatens to encroach upon so many of the office jobs that office workers believe were both unique, scarce, and valuable, productive? Artificial intelligence and its associated technologies threatens to provide an abundant substitute for jobs that were once considered to be the sacred domain of the university-educated office worker. All those systems, all that optimization, the emails, the memos, the pitches and the presentations, the administration and the analysis, the summaries and scheduling, the tasks and the to-dos, the reports and the research, the spreadsheets and the databases, the drafts and the reviews, mechanistic, process-driven jobs that may be productive, but to many normal people, not economists, they don't add a great deal of value. Productivity. What does it mean to be productive? Productivity, as defined by economists, is the relationship between inputs, labor, capital, and outputs, widgets, products. Profits are achieved by a company when outputs are maximized relative to labor and capital inputs. Since the 1980s and the Chicago School's neoliberal capture of politics and of markets, the goal for businesses has been to maximize profits by approaching business as an exercise in maximizing productivity. The consequences of this move away from generational businesses, caring in equal measure for their employees, communities, customers, and shareholders, to single-minded productivity maximizers, was to view labor and capital as equivalent. If a machine could do a task more productively than a human, then the human should be replaced by a machine. In fact, the smaller the employee base, the better. It is the arch capitalist dream to build a highly profitable business without the need for pesky humans. We first saw the disruptive nature of machine productivity during the Industrial Revolution. What was once the domain of the human, working with our hands, was replaced by the relentless productivity of specialized machines. At very narrow tasks, spinning fiber, weaving cloth, machines were far more productive than humans. Their input costs, machinery and upkeep, were far lower than labor relative to their increased outputs, more textiles. This was a time of fabulous profitability for the first mover industrialists and simultaneous hardship and destitution for many skilled workers who had suddenly seen their craft, for which they might have apprenticed for up to 7 years, taken away by the might of the machine. As Brian Merchant sagely concludes when summarizing the driving force of productivity maximizing industrialists, if the Luddites have taught us anything, it's that robots aren't taking our jobs, our bosses are. However, excess profits tend to bring new entrants. By the middle of the 19th century, more companies had been founded and factories were opened. More efficient, specialized machines were built and output increased, dropping the price of these machine goods, lowering the productivity and profitability of this machine work. Gradually, labor's machine substitute was becoming commoditised. Therefore, capitalists and innovators went off in search of new products, services, and industries that might yield greater productivity and, ultimately, profitability. After a tumultuous period of labor market disruption, new categories of jobs were created where labor could not be easily substituted by machines. Workers who adapted to this new reality thrived, retraining as factory managers and mechanics, and, in the language of economists, becoming complements to machines. Today, governments around the world are desperately trying to answer the productivity question, spending millions of dollars on costly reports and analysis, with no recognition of the irony, trying to understand how to unlock economic productivity. In recent decades, many policies were aimed at higher education and training, making sure people went to university, which brought a generation of blue-collar workers into the office, where their productivity was higher. However, productivity is not a static concept. It changes based on what we, as purchasers, consider to be valuable. Value. In the 2011 film Margin Call, based loosely on the 2008 Great Financial Crisis, fictional investment bank CEO John Told, played by Jeremy Irons, calls an emergency meeting of his top executives to discuss the disturbing findings of star analyst Peter Sullivan. Sullivan discovered that the mortgage backed securities the bank owns are effectively worthless, with the resultant losses from selling these assets at zero threatening to bankrupt the company. To save his company, Toll decides to sell these mortgage backed securities to willing buyers before the market realizes the worthlessness of the underlying assets. An argument between Told and head of trading Sam Rogers, played by Kevin Spacey, ensues, with Rogers challenging Told, who seems willing to sell something that he knows has no value. Told fires back with a quote that just about sums up our modern understanding of value. We are selling to willing buyers at the current fair market price. Since the 19th century, neoclassical economists have argued that value is based not on inputs, land, labor, or capital, or on the contribution of the product or service to human flourishing, but on the price that their customers were willing to pay. In economics terms, their marginal utility. Value has been reduced to a simple calculation driven by the twin pillars of scarcity and utility, or usefulness. This shift greatly pleased neoclassical economists. Using satisfying supply and demand diagrams, they can now set an equilibrium price based on balancing consumers' marginal utility, their willingness to pay, and the company's marginal cost, their willingness to produce. Armed with this mathematical certainty and a toolkit of seemingly Newtonian laws, these economists felt justified in calling their discipline a robust science. In fact, in the 19th century, British economist and creator of the theory of marginal utility, William Stanley Jevons, reduced value to the mechanics of utility and self-interest. Despite the clear limitations of a marginal utility theory of value, whole economies started to become oriented based solely on the market dynamics of supply and demand. We think that the value of an investment banker is greater than a nurse because investment bankers are a scarce resource and bank owners are willing to pay for the narrowly defined productivity of the bankers. It's why we think a full-time employee is more valuable than one who chooses instead to work part-time and look after their children. It's why we place more value on a rare Swiss watch than on a far more capable but abundant smartwatch. Linking scarcity, productivity, and value. As we have discussed, value, scarcity, and productivity are not static concepts. They change based on taste, trends, innovations, and technological breakthroughs. Let's take a very simple example. Say I retrain as a magician, which is not very likely to happen, focusing on delivering a wonderful experience at children's parties in my local area. At first, business is slow. There are 3 other magicians in the area, all with more extensive networks and a nice business in repeat bookings. Furthermore, the current trend in children's parties is bouncy castles, and no self-respecting parents would be seen dead hosting their child's party without an elaborate castle complex. To make matters worse, I don't have a car and have to travel to each booking on foot, which means I can only satisfy 1 booking per day. Here, my productivity is likely to be low because my outputs are limited to the number of bookings I can fulfill, while my value is lowered by the abundance of other magicians, substitutes, and a limited willingness to pay as there are many more attractive alternatives, bouncy castles. However, I persevere with 2 small changes. Firstly, I invest in a car, which means I can now complete up to 4 bookings a day. Secondly, instead of competing with the growing ubiquity of bouncy castles at children's birthday parties, I decide to change my act, positioning myself as the only magician in the local area that can pull rabbits out of hats whilst bouncing up and down on the inflatable. Suddenly, the bookings start flooding in, with my productivity rising as I can now satisfy multiple bookings in a single day. Furthermore, the demand for my act is so strong that I can start increasing my prices. By moving from a substitute to a complement and by becoming a scarce resource in a market where there is a growing willingness to pay, my value increases as my outputs are now much higher than my fixed inputs. As artificial intelligence makes abundance what was once scarce, the capability to complete various knowledge work, administrative tasks, and office based tasks, we must act quickly, seeking out jobs where human inputs are not substitutable by increasingly capable artificial intelligence and where there is a growing willingness to pay for the human product. Our enduring goal must be the deindustrialization of ourselves, to break free from unfavorable comparisons to machines and to artificial intelligence. Unlike technology with its tendency towards competition and scale based commodification, we, human workers, remain resolutely scarce. We are not substitutable or scalable. Unlike limitless technologies, we are joyfully bound by space and time. Instead of the post industrial urge to commoditize ourselves, fitting neatly into a functional job description, inputs and outputs, we must reawaken the things that make us uniquely human. By focusing on those things that contribute to human flourishing, we protect ourselves from artificial intelligence substitutes while simultaneously finding purpose and meaning in the work we do. We must seek jobs that protect and reward our unique human talents, found companies whose products and services are complementary to or not substitutable by artificial intelligence. These companies will endure because what they provide, human first creativity, craft, curation, community, and care, are both scarce and in demand in a society exhausted by narrow technological abundance. Furthermore, the benefits of these human first companies might extend beyond the narrow marginal utility conception of value when we focus on inputs, work, and outputs, products that contribute to human flourishing. We create value, positive externalities that falls outside of the market-based exchange. The once maligned and often unpaid work of caregivers, homemakers, volunteers, and community workers will be renewed as valuable and scarce contributors to human flourishing, sitting neatly alongside the productivity derived value created by the mainstream workforce.